Okay, I will try to record this so that we'll see. I think that is also 40 minutes, yeah? All right, so this is the chapter 2. We are going to look at your financials, basic, your financial statements. Okay. So as mentioned earlier, there are 3 types of financial statement. The first one is the balance sheet. All right, take note of the balance sheet is also known as statement of financial position. Can you write it down? Statement of financial position. The second statement is what we call income statement. Yeah. So before that, balance sheet is describe the enterprise at a specific date. So what it means is that when I say balance sheet, it say that balance sheet as at 31st of December. Balance sheet as at 30th of June, for example. Yeah. So when we talk about the financial statements, it tells you the information is as at that date. All right, because the position may change. The following day may no longer be the same as 30th of June, for example. Yeah. So the report is as at 30th of June or as at 31st of December. So when you look at the financial statement, it's always, for example, it could be on a monthly basis. All right. So you can have a financial report for every month. You can also, but most companies have their financial reports for every year. All right. So you have year end, for example, if your year end is 31st of December, so you have your financial statements or balance sheet as at 31st of December. Yeah. And then what else? Income statement depicts the revenue and expenses. So it tells you what is your revenue. Revenue is your sales. If you're talking about if you're selling goods, all right, then it's your sales. But sometimes you also have, you do not sell goods, you sell services. So for example, you're talking about company that provides services of a motor vehicle. So you provide services. So you don't sell goods, so you provide services. So later we'll see that there are 2 types of business, one that provides services and the other one that sell goods, right? And the revenue and expenses for a designated period of time. So you see that income statement for the year ended 31st of December. Income statement for the year, for the month ended. All right, so it means that if it's more for the month, so that is the statement for the month of that period. Right. The other name for income statement is statement of profit and loss. Yeah, profit and loss statement. So because it tells you whether the company is making profit or loss based on the revenue and expenses. The third statement is what we call statement of cash flow. And again, is the designated period of time. So it depicts the ways cash has changed during a designated period. So what is your opening balance of your cash and how you spend your cash and how you generate cash, for example. So all these are shown in your statement of cash flow. So there's no other name for statement of cash flow, right? One only. All right, so let's look at this example of a statement of financial position, which is the balance sheet. All right, so you see that here the name is statement of financial position. In other words, it's also what we call a balance sheet. So but now, all right, when you look at any, we call it as a statement of financial position, or students normally call it as a SOF, S-O-F-P, right? So you can have SOF, right, that tells you 3 items. Right, so in the financial position, you'll see that you will have your assets, right? So this is your assets. Where is it? Draw. Okay, so you can have your asset here, and then these are your liabilities and your honest equity. All right, so these are the 3 things that you'll find in your statement of financial position. All right, in this case, we have Vagabond Travel Agency statement of financial position, December 31st, 2015. So means that as at 31st December, these are the financial position of the company Vagabond Travel Agency. All right, so let's look at the asset of the company. The company has a cash of 22,500, notes receivable All right, so later we look at what do you mean by notes receivable? What is accounts receivable? And then you also have what we call supplies, and then you have office equipment and building and land. So these are what we call assets. So later you'll see that whenever you have this kind of account, it will normally fall under the category of an asset. Right? Later we look at what is the definition of an asset. Liabilities is what is your obligation to pay. Yeah, so your obligation to pay is what is your liabilities. Asset is your resources, what you have. Liabilities is what you have to pay, whether in the short run or in the long run. But in this case, they only put one under liabilities. You have notes payable. So we see notes payable, anything that is payable is a liability, because why? You have to pay in the future, right? You also have accounts payable, means that you have to pay, so it's a liability. Salaries payable means that salary that you have not paid, so it's a liability to you. But if you look at the assets again, you see that the term is receivable, right? Where is my mouse? I don't see my mouse. Okay, mana dia macam, right? Receivable means that you're going to receive in the future. So that's why receive, it means that something which is receivable is an asset. Yeah, notes receivable, accounts receivable, those are your asset. So, and then the other category is what we call honest equity. Yeah, honest equity is made up of your capital stock and your retained earnings. So later we look at what do you mean by retained earnings. Yeah, capital stock is the investment made by your shareholders to the company. So in this case, you see that Mak, you kat mana ni? I do not know where is my cursor. Okay, so you see that what is the total asset here is 300,000. Oh, I do not know how to, hold on, yeah. It's everywhere now. I just cannot. Right, so your asset total is 300,000 and your liabilities total is 80,000. Yeah, liabilities is 80,000, which is made up of your notes payable, accounts payable, and salaries payable. And your total equity, capital stock 150,000 and retained earning of 70,000. So if you look at on the asset, it's 300,000. On the right side is your liabilities, 80,000. Your owner's equity is 220,000. But you add on your liabilities and your owner's equity, you will also have 300,000. So you see that this is what we call the debit, the right side and the left side, right? Your left side is your asset. In this case, your asset is the debit side, and liabilities and owner's equity is on your credit side. So the left hand side is the debit, your right hand side is a credit. All right, so I'm introducing your debit and credit now. Yeah, so asset.
Prof.
Yes.
Sorry to interrupt. So I understand that assets is what we have in hand, right?
Yes, not in hand.
So
what belongs to the company? You cannot say what.
Okay, what belongs to the company?
Yeah, for example, your account receivable, you don't have it now. You are going to receive that in the future, but it belongs to you. Okay?
Oh, okay. All right.
Okay. So
I guess there is fixed asset and non-fixed asset also. Fixed asset means it will be something in not in the hand, means like properties. But non-fixed assets, that means something which we can convert it to the money. So on hand resources, it's totally different.
Yeah. But later you see that, for example, then of course, asset here later, we are going to categorize asset into current asset and non-current asset. All right, current asset means that anything that you can convert into money within 1 year. But your long-term asset or non-current asset, for example, your office equipment, your building and land, it's not easy for you to convert into money. So that's why we call it as a non-current asset. Yeah, I'm trying to close.
Later on, we will go to the details.
Yeah. Yeah. But I just want to show you here is how the financial statement of financial position is. It tells you three things. One is, what are the three things in the financial position?
Asset, liabilities plus owner equity.
Yeah, asset, liabilities, and owner's equity. Asset will always have the same amount as liabilities plus owner's equity. All right, later we look into that definition. But this is what a financial position is. Yeah, so you're going to identify what are assets, what are liabilities, and what are owner's equity. And then you have to decide how much is of each asset. Yeah, so later you see that how much cash that you have at the end of 31st of December. How much is your notes receivable and all these things, yeah? I cannot move now.
Sorry, Prof. So accounts receivable and notes receivable, that's something we'll be receiving in the future, right?
Yes.
Oh, okay, I got it now.
Yeah. I cannot move. Hold on. Give me a second. Where I can. Oh my God, what is happening? No, I cannot. Hold on. It's hang already. Oh my God, where is it? I don't have my cursor. What to do? What to do? I cannot move it anywhere now. Still not working. What should I do? Where is my cursor? What should I do? Can you still? Are you still here?
Yes, doctor.
Macam nak buat ni eh? I cannot stop. Pause. Okay. Macam nak buat ni? Buatnya.
Maybe you try to stop sharing first, doctor, and see how it may,
Okay.
if that may work.
I stop sharing.
Yeah, stop sharing the screen and then reshare again.
I cannot. I can't find my mouse. Is that?
Oh, then
I don't know. New share. Oh my God. I hate this thing.
Actually, this is normal problem of the online courses. No worries, we'll find it.
Hold on.
I think it's the laptop.
Is there?
Maybe it hangs.
All right. Can you see? Hold on. Yeah. Can you see it now? Or now it becomes the same? Aduh, wait. What should I do now? PowerPoint. I can't do this.
Oh, we can see the mouse now.
Hold on. Hold on. Okay, now I stop sharing and I share again. Where is it? This one. Where is it? Where is it? Okay, can you see this? Financial position?
Yes,
Prof.
we can see.
All right.
Yes.
Okay.
Doctor.
All right. So now is the where were we? What is it now? Okay. All right, there's your financial position. And then okay, a business entity is separate from the personal affairs of its owner. So what it says is that when you have a company, all right, you will have your investor. So investor are your owners. Is the owners of the company. So when you say, for example, ABC Sdn Bhd, yeah, Sdn Bhd is a Malaysian company, private limited. So we call it as a Sdn Bhd, SDN BHD. Or in the textbook, they will use a private enterprise, for example, yeah. So if you have ABC Sdn Bhd, so it means that the company, then you have to see who are the shareholders of the company. All right, so the shareholders are the owners of the company. So the shareholders, right, the entity, the ABC Sdn Bhd and the shareholders are two separate entities, right? So whatever the company is doing, all right, the shareholders are only responsible to the amount of the investment they have in the company, right? But if you're talking about the owner is a sole proprietorship, means that the company is owned by one person only, then it's a problem, because in an enterprise where we have sole proprietorship, there's a unlimited liabilities. All right, so it means that if anything happened to the company, all right, the owners will have the unlimited liabilities. Yeah. Okay, what are assets? So you see here, these are your assets, right? As mentioned earlier, the same. Here you have your cash, receivable, your supplies, office equipment, building, and land. So throughout the 6 weeks, all right, you will see that these are almost the same. What we call this one is the accounts, yeah? Cash accounts, your notes receivable accounts. So all these are your assets. All right, they are economic resources that are owned by the business and expected to benefit future operations. Right, so cash will benefit the company. Receivable, because they are going to receive that. So it is an asset and it's an economic resources to the company. Right, whether they have it now or not, it doesn't matter, but they know that they're going to receive that in the future, and that belongs to the company, right? Okay. Then we have, right, accounting principle. We get to asset, all right, we'll always use the cost principle. It means that we're going to record your asset at the historical cost. It means that whatever the cost of the asset, that is the amount that will be recorded. All right, so you use monetary value, and then going concern assumption. It means that we assume that the company will continue to exist. That is what we call going concern. All right, we are assuming that the company will continue to exist for a several number of years, right? But if the company is, they say that, okay, it looks like the company is not doing well, it may go into bankruptcy anytime. So we say that the company is not going concern, right? So it's very important, because if the company is not going concern, then nobody will invest in the company, no bank will give loan to the company, all right? What is a liabilities here? Right, are debts that represent negative future cash flow. Why negative future cash flow? Means that you have to pay in the future, right? So it's a liabilities are debts. So that's why we say that payable. So you have to pay in the future, right? So when you make payments, so then your cash flow will be negative. So in accounting, anything that is negative means that it goes out from the company. But if it's a positive, anything that goes into the company. And finally, we have the owner's equity, is the represents the owner's claims on the assets of the business. Yeah, so we have the capital stock is number one, is the amount of investment made by the shareholders. Retained earnings, later we'll see that what is a retained earnings. All right, later I'll show you what it means by retained earnings. Okay, so these are very important accounting equation that you must remember forever. All right, because the equation will never change, and in accounting you must always have these equation to be the same. Right, so we say that in accounting equation, when you have your assets, the value of asset must always be the same as your liabilities plus owner's equity. All right, for example, here you have your asset is total asset is 300,000. And how do you get that 300,000 is represented by your liabilities of 80,000 and your owner's equity of 220,000. So total liabilities and owner's equity is 300,000, which is the same as the value of your asset. All right. So remember this equation, asset must always equals to your liabilities and owner's equity. At any point of time, for example, when you do your financial position, statement of your financial position, you must make sure that your asset must always equals to your liabilities plus owner's equity. If it's not the same, something is wrong. Yeah. So it's a very straightforward indicator that something is wrong. Whenever you have your asset does not equals to your liabilities and owner's equity. But if you have an equal amount, It doesn't mean that you are right. Yeah, because there could be some other indication. All right, there could be some errors that I don't know, right? There could be, right? But if it's not the same, totally wrong. But if it's the same, you may be right or you still may be wrong. At least you know you are happy that, okay, at least my asset equals to my liabilities and honest equity. Right?
Doctor,
Yes.
can I ask you something? Why the capital is not on the asset?
Yeah, capital is actually sekejap the capital is actually tu mana berapa? Tak pergi balik ni. Your capital stock, kenapa is not an asset? Oh, sorry. Is that your question?
Yes.
All right. Because the capital stock is macam mana nak cakap capital stock does not belong to the company. All right, because that capital stock that create the asset later. All right, for example, I put money 200,000 into the company, and using that 200,000, I buy office equipment, I buy building, I buy land, for example, and I create from that capital stock. I create asset, right?
Oh.
So that's why capital stock is never an asset, because remember that just now we said that two entities, separate entity too, because you have to differentiate between the company itself and the investor.
So but when you talk about capital itself, cash capital, that will be asset, right? No,
cash there means that how much cash the company has at any point of time. All right. So for example, all right, later you see, later you'll see from the example what's the difference between capital stock and cash. Okay, let's look at the example here. All right, on January 10, Michael McBrien started overnight auto service. All right, he and his family invested 80,000 and received 8,000 shares of stock at $10 per share. All right. So what happened is that McBrien put in money 80,000 into the company. All right. So you put money.
Sorry, but your connection is keep on dropping.
I'm not sure what can I do about that. No, I just have to continue. Yeah. All right. So when I say that McBrien put money 80,000 into the company, so what they put is the money into the company. All right. In return for that 80,000 cash, all right, McBrien received shares in the company. All right. So how much is the shares? You receive 8,000 shares, and each share is $10 per share. So 8,000 times by $10 is the 80,000. So that 80,000 is what we call capital stock. All right, Johan?
You mean stock is about shares?
Yeah, capital stock is the share.
Okay.
All right. So capital stock, okay, this is US textbook. All right, sometimes they put it as a shares there. Right, it's capital stock, but in this case we call it as capital. Sometimes we call it just a capital like that. Yeah, so these are the shares. So when you put money into the company, the owners will receive shares. So later when you receive dividend based on the shares that you have in the company. Is that clear? All right. So here we
just to be clear, is it as owner equity also as profit for the company?
No.
It's considered as a profit? No, huh?
No. Later we look at the retained earnings.
Okay.
Yeah. So here we have the capital stock. So this will be the first transaction of the company. So whenever you have put money into the company, then you have the capital stock and then you have the cash. So at any point of time, remember the asset, how much the asset? 80,000. You don't have any liability, so liability is zero, but your owner's equity, or sometimes I call it as OE, all right, is 80,000. So you have the asset equals to your owner's equity. Yeah, so you have that 80,000 now on both sides. So I always refer to the left side and the right side. Yeah. Okay. The next one is that you see that on January 21st, overnight purchased land from the city for 52,000 cash. So
Prof, your
yes.
connection is really weak. Anyone is facing the same?
Is everyone
No,
experiencing?
for me it's okay.
Ah,
I'm not sure because the connection here keep on dropping most of the time. Anyone is facing the same issue, or am I the only one?
I don't have any problem. It's okay. The presentation is very well. So we present
Yeah,
on the
I
screen
have-
very well. I don't have any problem.
Yeah, I have no
never
problem.
mind,
too.
honey. Later you can watch the recorded session. Yeah, if the internet is not okay on your side. Because I'm not sure also whether mine is okay or not. But if others say that I'm okay, then it means that I'm okay. All right. Okay, we only have 10 more minutes before the Zoom went out. Okay, and the next happen is that you purchase land from the city for 52,000 cash. So what happened here is that, just now remember you have cash of 80,000 from the investment from the investor, the owner, Matt Bryan. So what you do now is that you use the cash to buy land. And when you use the cash, now land, now do you still have cash 80,000? Of course you don't, because you use the cash from 80,000, 52,000, you buy land from the city council, right? So what happened here is that, right? So your cash now reduces, but you have now created a land asset. All right. So when you purchase cash with cash, so your cash have to reduce, but now you create an asset called land. So now you have two types of asset, cash and land, and total of the value of cash now from 80,000 now becomes 28,000. But the asset also increases because now you have land of 52,000. So cash plus land, you have total of 80,000. Capital stock, there's no change because the transaction when you purchase land for cash, right, does not involve capital stock. So there's no changes in the capital stock, but there's a change in your asset. All right, the form of asset now changed from cash of 80,000 now become cash of 28,000, but you have increase in land of 52,000. The next one is that on January 22nd, overnight purchase an old garage for 36,000. Overnight paid 6,000 in cash and issued a 90-day note payable for the remaining 30,000 owed. Do you understand what is happening now? Let's see Hidayat. What happened here? Yes, Hidayat.
Yes.
Dia punya intro tu belajar.
Sorry.
Is that okay?
Because I'm the alumni of COVID, so I cannot speak much word because after I speak, I will caught.
Can you answer me or not?
No good.
Okay, let's see Hani.
Which honey, doctor?
Oh, do we have two Hani? Oh, Hani Mansur and Hani
Yeah.
Al-Ghuzi.
Yes,
So how should I address one of you?
brother
Maybe
and sister.
Brother Hani.
Okay.
Yes, Prof.
Okay, what do you see here? What are the transaction here? What happened here?
Okay, okay, I can see the assets, which is the three transactions. We have got the cash,
Mhm.
land, and buildings. Okay, so these are like the three assets that belongs to the company.
Mhm.
And on the other side, the liability is what the company owe,
Mhm.
right? Am I right?
Yes, correct.
Because, like, for example, they're not payable, which is something that the company has to pay in the future, and the owner's equity is this is the capital. This is what the company invested, like plusing 22 plus 52 plus 36.
Okay. So what
So
I'm
that's the
saying now
capital
is
stock.
that, what do you understand from, for example, if I don't show you this, hold on, yeah.
Mm.
If I don't, where is it? Oh, Am I going back or going forward? Okay, this one. Right, you purchase an old garage. So old garage here we refer to a building. Yeah, so old garage is a building, and what is the cost of the garage? Is 36,000. Okay, so that 36,000, how do you pay for that 36,000? You pay in cash 6,000. So it means that from 36,000 you pay cash 6,000, so you have a balance of 30,000. So how do you pay that 30,000? You're going to pay that in the future. All right, because why? You issue note payable for the 30,000. So note payable, is it an asset, liability, or owner's equity? What is it actually?
I'm sorry, could you please?
What is a
If
note?
it's, if it's payable, of course, it's a liability.
It's a liability, right? So
If
means
it's payable, it's liability, yeah.
yeah, whenever you have a payable, you know it's a liability. So what happened now is that, right? So you buy a building, a garage, all right, for 36,000. So that's why you have now additional building of 36,000. But remember that your cash just now reduced. Initially, it was 30,000. What was it? Initially, it was 28,000, isn't it? Right? And now it becomes 22,000. Why? Because you pay out cash 6,000 for the building. So that's why your cash reduces from 28,000 to 22,000. Land, there's no change because there's nothing involved land, but you have created one liability which is called notes payable. Well, how do you know it's a notes payable or accounts payable? Look at, if they say it's a note payable, it's a note payable. Right, it's very straightforward. And the note payable is 30,000. So when you have note payable of 30,000, so 30 plus 80 is 110. On the other side, on the asset side, you have a total of 110,000 as well. Yeah, so now you have on the asset side 110. On the liability and owner's equity, you also have 110,000. Right? So whenever you look at the transaction, right, you have to understand what happened. All right, whether the company, whether your cash increases or there's a building that increase or there's an increase or decrease. You want to look at that point of view. All right, so now you see that from here, there's a building increases where you pay cash, cash decreases by 6,000. And now you have note payable. Before this, you don't have note payable. Now you have created a note payable of 30,000. So you create a liability. So far, so good?
Yes, doctor.
Okay. So let's look at the next one. On January 23rd, overnight purchase tools and automotive repair equipment. So now what happened is that now you buy tools and equipment. Yeah. For 13,800 on account, which is due within 60 days. So what do you understand by that? Noor, Sister Noor, Hani.
From what I understand, it's like if it's first time stamp, it's also notes payable.
Okay. Whenever you don't see the term note payable, all right, don't open note payable. You open accounts payable.
Oh, okay, account payable.
All right. So what happened actually? What increase?
The liability.
Liability increase. So liability side increase. So what about the debit
Yes.
side?
The debit side,
The asset.
because
What
the
increase?
asset, what increase is the capital stock?
No. Why capital stock? Capital stock is not an asset. What do you buy here? You purchase tools and automotive repair equipment.
So the just now it has land and building. So it
Now?
increased in terms of the material, which is the tools and automotive equipment that they need for the.
All right. Very good. So now on your asset side, you have additional tools and equipment. Yeah. So why is it not tools and automotive repair equipment? Because the term in normal accounting, we call it as a tools and equipment. Yeah. So you don't have to have the full term kat situ lah. Alright, because later you see that tools and equipment, you have many other tools, equipment that you are going to buy under the same account. Alright, so now you have increased your asset of 13,800 in the form of tools and equipment. At the same time, you create accounts payable. So whenever you see the word